Okay, so the next topic that is covered in the chapter is contingent liabilities. So this is a liability that's not actually there yet because it's based on the happening of some other event. Okay, so a lawsuit is like the classic contingent liability where you're only going to have a liability. You're only going to owe someone money if you lose a lawsuit. Okay, so that's that the lawsuit claim payable is only going to happen if you lose the lawsuit. Okay, so a warranty you can say is also contingent. It's contingent on something breaking. Okay, we're going to take an expense for it because we know that things break. A lawsuit is a little more discrete, right? You don't like lawsuits are discrete events, right? A warranty, if you're selling a lot of products, you just statistically know some of them will be bad, and so you can take an expense for it. But a lawsuit is going to be dependent on like what lawsuits are actually happening in your business. A guarantee, okay, so this is a common one in real estate. Uh, a investor is going to set up some LLC. Let's just say LLC, and then the LLC is going to own some building. Now, the bank, if they needed to finance the purchase of the building, they're going to technically lend to the LLC because the LLC is the thing that owns the building. However, the bank knows that there's only one asset in this LLC, and they may ask this person to provide a guarantee to the loan, meaning that let's say the loan goes bad. If the bank sells this, let's say the loan was for 10 million. If they were only able to sell the building for 8 million, that $2 million deficiency, if this person is given a guarantee, they're going to have to come up with it. Okay. So it's a contingent liability in that it's contingent on there being some deficiency. Okay. If the building sold for 18 million, then the bank would get all their money back, right? And the guarantee would no longer be relevant. So it's only if the number one, the loan goes bad, and number two, the asset that is secured by the loan is not sufficient to pay off the loan. Okay, um, so this is bankrupted a lot of real estate like owners, investors. Okay, they give guarantees expecting nothing's going to happen, but when it comes down to it, they can lose everything. I actually know a guy. He was a tech guy, and he started in the real estate kind of investing game, kind of when I did, and he made a lot. He like grew his business into like a really big, like large scale, like apartment building developments. But he was giving personal guarantees on all the loans, and things just turned. I think this was like I don't know if it was during COVID. I think it was after COVID maybe. But basically, he lost everything. He lost all his personal assets, and of course the paper gains that he had on all the development projects. So these guarantees can really, really burn you. Okay. People go to zero over it when they're old, because you don't expect all your things to go bad at the same time. But actually in real estate, and even like stock market and stuff, that's the correlation is quite high, higher than people think. Okay. And then, investigations, this is probably related to lawsuits. How businesses record, okay, these contingent liabilities. It's going to depend on the likelihood that it's going to actually become a liability. So, and this is a little, there's like leeway that management has because they're going to determine these probabilities. So if they determine that it's a remote possibility that there's going to be a contingent liability, there's no disclosure. You don't have to write about it in your financial statements at all. And of course, there's no journal entry because it's not a likely thing that's going to happen. If it's reasonably possible, okay, then you just have to disclose it in the notes. You'll have in the financial statements of like public companies, they'll have a whole section devoted to like lawsuits, for example. So you would write, "Hey, we're being sued by this person, and it's reasonably possible that we could lose and be subject to some $10 million lawsuit or $50 million, whatever it is. Okay. Um, there's no journal entry though, because again, it's not yet a transaction. Nothing's actually happened. Now, the last one is if it's probable. If it's probable, you'll have to disclose that for sure. And the crazy thing is, if you don't know the amount of it, and you can't reasonably estimate how much the liability is going to be, you don't have to do a journal entry. You just have to disclose, hey, we're probably going to lose this lawsuit. We don't know exactly how much it's going to be, and it's not actually going to be reflected on the financial statements, like on the balance sheet. If you can't reasonably estimate how much it's going to be. If you can, then you will have to have a journal entry that says, lawsuit expense, whatever, 100 million, and lawsuit payable. Lawsuit claim payable. It's unpayable because you haven't actually lost the case yet. You're probably going to lose it. But at this time, if you really determine you're probably going to lose, you have to take this expense. And that's going to impact your income statement, your profitability. And of course, you're going to have this liability that you'll have to pay at some point. I've never actually had to deal with this, but I would assume that if you're probably going to lose a lawsuit, your auditor is going to really push you to estimate the amount. I don't think it's like very common where you'll have a probable situation where you're going to lose a lawsuit, but you don't actually do a journal entry. It's like that's going to be pretty shady. It probably has to be a really specific case to allow that. If you're probably going to lose, you're going to take an expense for it. Even if it's not the best estimate, you'll probably be pushed to make some estimate.